Stop what you're doing right now. I need you to close every other tab on your browser. I need you to put down your coffee, silence your phone, and lock the door. I need your absolute undivided attention for the next 20 minutes because the financial media is lying to you. They are lying to you by omission. They are showing you the scoreboard, but they are hiding the fact that the stadium is burning down. I want you to look at two numbers, just two numbers, because these two numbers right now, as we speak on January 15th, 2026, are the most dangerous digits in the entire global financial system. They are not stock prices. They are not interest rates. They are evidence of a crime scene. Number one, $91.67. This is what the Comex in New York claims silver is worth. This is the price you see on CNBC. This is the price your broker quotes you. Number two, $104.55. This is what the Shanghai Futures Exchange is actually paying for it. The difference is $13. $13 on the same ounce of the same metal at the same second. In a sane world, this is impossible. In a functioning market, this is impossible. The law of one price states that an identical asset cannot trade at two drastically different prices for any significant length of time. But we are no longer living in a sane world. As of this morning, the laws of financial physics have officially broken. The global silver market has snapped in half. If you are holding paper silver, you are holding a lie. If you are holding physical silver, you are holding the only truth left. Do not adjust your screen. Do not refresh your browser. The data is real. The arbitrage is dead, and the panic is just beginning. Ladies and gentlemen, welcome back to Veiled Wealth. It is January 15th, 2026. Let's expose the breach. To understand why this is the end of the fiat pricing model, you have to understand how the machine is supposed to work. For the last 50 years, the global silver market worked like a bathtub. The water, the liquidity, was free to flow from one side to the other. If the water level rose on one side, gravity pulled it to the other side until it was level. This is called arbitrage. It is the connective tissue of the global economy. If silver was even $1 more expensive in China, sophisticated traders in New York, London, and Zurich would instantly wake up. They would buy metal in the cheap market, fly it to the expensive market, sell it, and pocket the risk-free profit. They would do this thousands of times a day until the gap closed. It is free money, and Wall Street never leaves free money on the table. But today, the water on one side of the tub, the east, is $13 higher than the other side, and the water isn't moving. The gap isn't closing. In fact, it is widening. Yesterday it was $8. Today it is $13. Tomorrow it could be $20. Why? Why are the banks leaving billions of dollars of arbitrage profit on the table? Because the pipe connecting the two markets is blocked. Or worse, the pipe is empty. The $13 spread proves one terrifying fact that JP Morgan and the LBMA have been trying to hide for years. Western banks cannot find the metal to ship. They see the free money. They see the $13 profit per ounce staring them in the face. But they are paralyzed. They cannot execute the trade because the New York vaults are effectively barren. The registered inventory at the Comex, the metal that is actually available for delivery, has turned into a ghost town. The owners of that metal are not selling. They are holding. And the banks, who rely on paper shuffling to keep the price down, have run out of chairs in their game of musical chairs. We are witnessing the erection of an iron curtain in the precious metals market. On one side, the East, they have the metal, they need the metal, and they are setting the real price based on physical scarcity. On the other side, the West. They have the paper derivatives, they have the debt, and they are trapped in a delusion that $91 is the real price. Now, you might be asking, why doesn't the price in New York just rise to match China? Why doesn't the Comex just jump to 104? Oh, they tried to stop that. They tried everything to prevent the price from rising. They threw the entire kitchen sink at this market. Just 48 hours ago, on Tuesday, January 13th, the CME Group, the exchange that runs the Comex, raised margin requirements by 15%. For those who don't trade futures, let me explain what this means. This is the equivalent of a casino changing the rules in the middle of a poker hand because the house is losing. They made it 15% more expensive to hold a long position. They tried to force the little guy, the retail speculator, to liquidate his position because he couldn't afford the new margin. It was a calculated, coordinated attack. It was designed to manufacture a sell-off. It was designed to smash the price back down to $80 and let the banks cover their shorts. And guess what? It failed. The price didn't drop. It paused, it took a breath, and then it ripped higher. This is the most bullish signal I have seen in my entire career. When a margin hike fails to kill a rally, you know the short sellers are dead. It means the buying pressure is not coming from leveraged speculators who are weak hands. It is coming from physical buyers, sovereign wealth funds, industrial users, family offices, who don't care about margin requirements because they aren't buying contracts to gamble. They are buying contracts to take delivery of the bars. The banks fired their biggest weapon. They used their nuclear option of margin hikes, and the market shrugged it off. That is the definition of a squeeze. That is the definition of a market that has slipped out of the control of the manipulators. But if you think the China premium is wild, you need to look at India. Here at Veiled Wealth, we don't just look at screens. We track the street price, the real price that real human beings are paying to protect their families. Reports coming out of the bazaars of Mumbai, Delhi, and Bangalore are painting a picture of absolute panic buying. Silver is trading at 290,000 rupees per kilogram. Let's do the math on that. Convert the rupees to dollars. Convert the kilos to troy ounces. That comes out to $132 per ounce. $91 on your computer screen in New York. $132 cash in hand in India. That is a $41 premium. That is a 45% premium over the paper price. Why is India paying 45% more? Are they stupid? Do they not have internet access? Do they not see the Comex price? No, they are smarter than us. They are desperate. The Indian population understands something that Americans and Europeans have forgotten. Paper promises burn. They know that when the rupee falters or when the supply chain breaks, you cannot eat a futures contract. You cannot build a solar panel with an ETF share. You need the metal. Refineries in India are reporting force majeure on deliveries. Dealers are putting up sold out signs. People are trading gold jewelry just to get their hands on silver grains. This is what a hypermonetization event looks like. Silver is returning to its role as money faster than the banking system can handle. The people of India are voting with their wallets, and they are voting against the paper system. So where does this leave the banks? Where does this leave JP Morgan and the bullion desk at HSBC? They are currently stuck in what traders call a widowmaker trade. For decades, they have operated on a simple model. Sell paper silver when demand is high to cap the price, and buy it back when demand is low. They acted as the managers of the price. They sold paper silver they didn't have, promising to buy it back later. Well, later has arrived, and the price is $13 higher than where they sold it. But here is the nightmare scenario for them. They cannot buy it back. If they try to buy paper contracts to close their position, they drive the price to $150 or $200 instantly due to the lack of liquidity. If they try to buy physical metal to deliver against their shorts, they find empty vaults. They are trapped in a burning building with no exits. And this $13 spread, this is the smoke coming from under the door. They are staring at technical bankruptcy. If they were forced to mark their positions to market, to value them at the real price of 132 instead of the fake price of 91, many of these bullion banks would be insolvent. This is why they are fighting so hard. This is why they raised margins. This is why the media is ignoring this story. They are praying that if they ignore it, it will go away. But math does not go away. Empty vaults do not refill themselves by magic. And we haven't even talked about the industrial users yet. What happens when Tesla realizes it can't get the silver for its EVs? What happens when Apple realizes it can't get the silver for its iPhones? What happens when the solar panel manufacturers, who are mandated by governments to triple production by 2030, realize the supply chain is dry? They are not going to look at the chart and say, oh, the RSI is overbought, we should wait. No. They are going to panic. They are going to call the refiners and say, I don't care what the price is. I need the metal to keep my factory open. I will pay $150. I will pay $200. Just send the truck. We are approaching the moment of unobtainium, a moment where the price on the screen doesn't matter because there is no buy button available for size, a moment where having cash is meaningless if you cannot convert it into the resource you need. The $13 spread is the early warning signal that the industrial users are bypassing the Comex and going straight to the source, paying whatever premium is necessary. So what is the play? What do you do on January 15th, 2026? How do you position yourself to survive the death of the paper market? Number one, ignore the spot price. The spot price of $91 is a zombie price. It is a reference number for a market that no longer functions. Do not sell your physical metal for $91. The real world is paying $132. Do not let a dealer lowball you. You hold the leverage. You hold the asset that cannot be printed. Number two, audit your holdings. If you own SLV, you own a claim on a vault in London that, as we just discussed, is being drained by China. Is that a risk you want to take? If the vault is empty, SLV shares become pieces of digital paper worth zero. If you own unallocated silver in a bank account, you are an unsecured creditor. You are lending your money to the bank. Get it out. Make it physical. If you can't hold it, you don't own it. Number three, the buy window is closing. I cannot stress this enough. The fact that the spread is widening means the physical metal is disappearing. If you can still find metal today, even at a premium, secure it. Do not worry about paying $5 over spot. Worry about the day when spot is irrelevant. We are moving into a seller's market for the first time in 40 years. This is the great decoupling. The East has the gold, the East has the silver, the West has the debt, the West has the paper. The $13 spread is not a glitch. It is not a computer error. It is a divorce. The physical market is filing for divorce from the paper market. And the settlement is going to be brutal. When the papers are signed, silver will not be $91. It will be priced at whatever the desperate industrial user, the desperate sovereign wealth fund, and the desperate Indian housewife is willing to pay. 200, 300, 500. Pick a number. In a hypermonetization event, the price is measured in the falling value of the currency. Do not be on the wrong side of history. The banks have lost control. The margin hikes failed. The vaults are empty. The Iron Curtain has fallen across the global economy, and you need to make sure your wealth is on the right side of it. This is Veiled Wealth. It is January 15th, 2026. The spread is $13. India is at 132. Get out of paper. Get into physical. Do it now. Subscribe, and share this video before the rest of the world wakes up to what is happening. We are watching the system burn together. See you on the other side.